Hi there, Genevieve Stoll with Windermere Real Estate. I'm here today with Greg Anderson of Penrith Home Loans. We both work in the Seattle area, and on today's episode of Ask the Lender, we're going to be discussing timing the market. So Greg, I work with a lot of home buyers, would-be home buyers, and they often want to know whether or not it's a good time to purchase a home because they don't quite have that 20% down payment saved up yet, and they don't want to pay private mortgage insurance.
Right.
So they think that they want to wait a couple years until they have a bigger nest egg and then invest in a home.
Right.
What would you tell those buyers?
Yeah, so I get that question a lot too, obviously, and I will say that not only is there a way to buy out of the mortgage insurance, so if you reference our other video about mortgage insurance,
take a look.
You can check that out. But also, a lot of times people don't think that it's a wise investment to make in a home if you're not putting 20% down. Mm-hmm. Frankly, a lot of those feelings come from parents and grandparents that when they bought homes, you had to put 20% down. In today's market, you can put as little as $0 down, although in some cases it's better to put a little bit down because you'll get some better terms. What I always ask people is if they come in and they say, I want to wait till I save 20%, I'll say, how long does it take? And, if they say, 3 years, okay? Then I do a calculation for if they were to purchase that home today. Mm-hmm. So let's say they were going to buy a $500,000 home today, and they were going to have 5% down. Okay, and they have mortgage insurance, and rates are say 4.5 or whatever they are right now. What we have to do is we have to project out what is that $500,000 home going to be worth in 3 years. Mm-hmm. Okay, what are rates going to be in 3 years? And so if you get just a 1% increase in interest rate and you get 5% annual appreciation, which is pretty standard appreciation for the housing market here, you're going to be looking at paying a lot more for that $500,000 house. It's going to be closer to $600,000. So even though you won't have mortgage insurance, your payment is actually going to potentially be higher if you wait, and you've lost out on roughly $100,000 in appreciation that you have gained. There's a thing called leverage, and most investors understand that you want to use leverage. You want to leverage someone else's money to make money. If you go out and you buy shares of Microsoft and you want to buy, say, $10,000 worth of shares, you have to give them $10,000. Well, if you want to buy a $300,000 home, you only have to give maybe $10,000, right? So it's a great way to let that vehicle grow for you, and then also not to mention the tax benefits that you will get, and just the happiness of living in your own place versus a rented place.
Right, exactly. And the other important thing to note, I think, is that private mortgage insurance does eventually go away. Right. And once you've paid down your loan a certain amount, or once, as you were talking about earlier, once a home appreciates to a certain amount, you're going to stop seeing that monthly PMI payment probably a lot earlier than you think.
Right. So, everybody's situation is different. We always say this. So it's different than your friends, your family, and your coworkers. So reach out to us. We'd be happy to run some numbers for you and show you the cost of either buying now or waiting into the future.
Absolutely. And if you like this video, please feel free to share it with your friends. Comment down below so that we can hear your thoughts. And we would love to see you tune in for the next episode of Ask the Lender. Thank you so much.